Oracle just shocked the market. The remaining performance obligation blew past $500 billion, and yet the stock still got punished with a drop of over 10%. So, what's going on? Is this panic justified? Or is Oracle actually playing the smartest long-term game in AI? Let's break down the real story, fast and simply. Oracle's remaining performance obligation just crossed $523 billion. In the last quarter alone, new deals from companies like Meta and Nvidia added $68 billion to that number. Why does this matter? Because one of the main bearish arguments was that Oracle depended too heavily on one client, OpenAI. Remember that huge $500 billion 5-year compute deal announced a few months ago? The stock spiked 33% intraday, then gave it all back as investors questioned whether OpenAI could actually afford it. These new customers do not eliminate the risk, but they make that bearish thesis less serious because Oracle's backlog is clearly become more diversified. The truth is that Oracle delivered a solid quarter. Total revenue reached $16.1 million, which represents 13% growth year over year. Even more importantly, cloud infrastructure revenue surged to $4.1 billion, marking impressive 66% year over year growth. That means Oracle Cloud Infrastructure is still expanding faster than its main competitors. So again, why did the stock fall? One word, CapEx. Oracle announced that because of these massive new contracts, they now expect 2026 CapEx to be $15 billion higher than previously forecasted. And here's the problem. Oracle hasn't been free cash positive for a year now. Last quarter, they hit a new low, minus $10 billion in free cash flow, and analysts do not expect them to turn positive again until 2028. Of course, investors panicked, that's normal. But here's the truth, this is how AI infrastructure works. You spend billions upfront to build data centers long before the revenue shows up. Every company in this space is doing the same thing. The difference is that Oracle isn't building blindly. Management said clearly, we pursue expansion only when it meets our profitability requirements and the capital is available on favorable terms. Translation, they only build when they already have the customer lined up. This is not Meta spending $200 billion hoping it pays off someday. Oracle increases CapEx only when the revenue is guaranteed. They are not overbuilding, they are not overspending. Every data center they are constructing will be used by big tech and AI native companies. So, no, this isn't a reckless bet. It's the right bet in a world where AI compute demand is exploding. Short term, margins look ugly, cash flow looks worse. Long term, Oracle is positioning itself as one of the core AI infrastructure providers on the planet, backed by hundreds of billions in contracted revenue. Whether the market sees today or not, the fundamentals speak loudly.